You have to take your chances in trading. Now, I want to share a story with you of the early days in my career. And then what I'm going to do is I'm going to illustrate the importance of being an opportunistic trader. Now, in 2012, I genuinely believed I was hands down the best one lot trader. Okay. I could take more ticks out of the market than anyone else. I was pulling 30 ticks a day out of the market every single day on average. And I did this consistently for an entire year. Now, the funny thing is that I was hands down the most consistent one lot trader, but I was also the trader with the smallest trading account. Why? Well, because everyone else around me was dialing in their ability to deploy controlled aggression. What do I mean by controlled aggression? Well, basically, when my A trades came along, think of that breakup. Think of bang, I see it break through the highs. I can see that low volume. I can see that volume pick up. I can see the one. I see it all. I see everything coming through. I'm sat there and I got my perfect execution, my perfect one lot. And I'd hold on to it all the way to target. Makes my 50 ticks. And I'm sitting there smug as a rug thinking, wow, I got this. I made 50 ticks. That's double what I made yesterday with my 25 ticks. And I've made $500, whatever it might be. The reality is the guy next to me doing the exact same trade. He used 5 lots. He's taken $2,500 out of the market, executing the exact same trade. Now, if there's one key lesson that you can take from this topic, it's this. You will not build a trading account playing it safe all day, every day. We are speculators. When the odds are in our favor, we need to deploy controlled aggression and take advantage. It took me an entire year to learn this lesson, and I cannot stress this more. You have got to learn to be capable of taking advantage when the time is then. Now, let me be clear. Controlled aggression does not mean deploying over-leveraged positions. You're still applying leverage, but you're applying a degree of leverage that's within your existing risk parameters. Okay, as an example, if my daily stop is $2,000 and I typically risk an equal amount of $400, so I'm taking 20% of my daily stop, $400 on every trade. That's what I normally risk. Now, on specific setups where I believe I've got confidence, we call these A trades, I can double or triple the risk on that one trade. So instead of risking only $400, I can risk $800 or $1,200. Now, if I lose $1,200 in a single trade, I'm not stopped out. I'm simply trading within my daily stop parameters. And this is the key to using controlled aggression. We need to be capable of sometimes deploying a little bit more risk at the right opportunistic moment to take advantage when the odds are in our favor. But it's got to be done with priority number one in mind, which is always risk management number one. And below that is being able to scale within our predetermined parameters. Okay, so risk management says $2,000 per day. Risk management says $400 per trade I take. Now I need to trade within those parameters and not step outside of them. That is what controlled aggression is. Now, why controlled aggression works so well is that ultimately it sprinkles out the equity curve with little sprints. Okay, and I'll show you what I mean by this in the next slide. In fact, let's go to that next slide. So ultimately, when we're using this controlled aggression, it gives us these little sprints on the equity curve. Okay, and that ultimately enables us to increase our position size on future trades. And moreover, don't forget, progression in our equity curve is hugely important for paying bills, for paying ourselves a wage, and just for progressing as a trader. Okay, so what you've got in front of you is two charts, two equity curves. Okay, and these are typical equity curves. Don't worry too much about the figures. Don't think too much in terms of, oh, my account will only be at this number. This is an illustration to really highlight what happens when you learn to deploy controlled aggression. Okay, so where I want to start with is I want to look at what I'm going to call Mr. One Lot Trader. And Mr. One Lot Trader is in the yellow line. Okay, and on the x-axis, we've obviously got years 1 to 4, and on the y-axis, we've got account balance. Now, what you can see is Mr. One Lot Trader is me. It's that trader that always just trades one lot, always just sticks to risking $400 per trade, never ever deploys controlled aggression. Now, in year 1, everyone's going to follow the same path. You're all going to have some form of a drawdown. Okay, it doesn't matter who you are, how smart you are, how clever you think you are, you will have a drawdown. That comes without saying. Why? Because there's costs involved with trading, whether that's educational costs, whether that's software costs, commission costs, whatever it might be. There are costs involved. Okay, and you're not expected to actually make a gross P&L in year one. You're expected to kind of just slowly leak out capital of your account. That is very typical, very normal. Now, the degree of drawdown is very dependent on how you approach it. If you think you're smart and you want to just have a swing of the bat without deploying any kind of a risk management strategy, well, your drawdown is going to be a lot deeper because you are going to eventually have that bigger than expected or bigger than wanted stop out day. If you approach this smart and you listen and you forget about making money, instead you focus on making experiences, what will happen is your drawdown will be shallow because the P&L at the end of every single trade is mostly irrelevant. You're losing $5 here, $10 here, $50 there. It doesn't add up to any significant amount relative to that initial account balance of $10,000. Okay, so how you approach that first stage is very, very crucial, but everyone's going to have that drawdown. Now, Mr. One Lot Trader in year one has a drawdown, okay? Ultimately, towards the end of year one, he's got a little bit more experience. He's starting to gain some traction, okay? He's starting to gain some consistency because guess what? If you're only ever losing one lot, if you're only ever, deploying $400 per risk per trade, there's consistency, okay? And like I said, if you're consistent, you will get the results as the byproduct. Now, at the end of, midway through year two, this Mr. One Lot is now breaking even. Okay, and that's that point there. You can see he's breaking even. He's back at that original $10,000 account that he started with. At the end of year two, you can see, let me start again. At the end of year two, our One Lot trader has now gotten back to break even. Okay, so it's taken him 2 years. He started with $10,000. He had that drawdown, and he's now gotten his way back to that $10,000 account. Okay, he now continues to progress that account, and he's steadily increasing that P&L to year three. And again, when he gets to year four, he's now doubled that account. Now we can all see this is a really good equity curve. It's nice and consistent. And because he's always using One Lot, because he's always just sticking to $400 losses per trade, it's nice and steady. There's very little drawdown there. There's very little stress on the equity curve. And this is nice. It's comfortable. But the reality is, who's going to work for 4 years to make $10,000? Who can afford to do that? None of us want to work for 4 years to make $10,000. Unfortunately, however, too many traders come into this job without understanding the basic concept that to make money as a trader, you actually have to put money at risk. Okay, if you're not willing to lose that original $10,000, you can't expect to make the $100,000. Moreover, it's very, very important to forget about the money in year one. And I stress this. You don't want to be thinking about making money in year one. You want to think about making experiences. You want to think about learning to deploy aggression. Because in year two, that aggression that you deploy will start to turn into some form of a P&L. And that's where we're going to go next when we discuss our deployed aggression trader. Okay, so if you're coming to trading looking just to make a wage, what I suggest is go away and go get a paid job. Walk away now. You shouldn't be doing trading for a wage. There are far easier jobs that you can do to make a wage, and trading is not one of them, right? The risks involved with becoming a trader, the sacrifices involved with becoming a trader are far too great just to simply accept a wage, okay? And that's why I want you to start thinking of yourself as a controlled aggression trader, because only in that environment are you going to make money as a trader, okay? Now, let's talk about Mr. Controlled Aggression in the red line, all right? He has the exact same year one, the exact same drawdown. There's no difference because it doesn't matter who you think you are in year one, whether you're Mr. Aggression, whether you're Mr. Consistent, whatever. At the end of the day, you're all going to have to pay to learn. That's just how it works. Okay, now what happens though is in year two, Mr. Controlled Aggression has got sufficient amount of experience to begin deploying this controlled aggression. Okay, now sure, in the beginning, you're still figuring out how to do it, and you're a little bit more sporadic in when you apply it because you still don't really know, which are your A trades, which aren't. But ultimately, in that year one and two, you get a slightly steeper curve. Okay, why is that? Well, because every now and again, I'm using a 2 lot instead of a 1 lot. Every now and again, I'm using a 3 lot instead of a 1 lot. Right? Yes, and I'm going to get it wrong as well. Doesn't go, it's not like it's a guarantee that you're going to win on your A trades. The point, however, is that when you look over a course of a year, you look at all the trades they took where they put a little bit more risk on, it averages out to a higher P&L curve. And that's the difference between the yellow and the red line. Okay, it's that difference in P&L that gets accumulated because you've taken on that additional risk in certain circumstances. Now, in year 3, and this is crucial, in year 3, we still continue to see ultimately that gradual incline because what's happening is that the trade is still learning. Like I said, you won't know your best trades in year 1 and 2, and your best trades will only become apparent in year 3, 4, 5, 6, 7. Okay, that's just the reality. So again, there's no real exponential movement in the equity curve until we get to some form of a threshold. Okay, and that threshold is just simply the point at which the trader, the skilled aggression trader, is capable of deploying more risk more often than not on his best trades. In other words, that sort of win ratio on his best trades versus other trades starts to increase. Okay, and that's the point at which this curve now turns very exponential. And that's what you're after as a trader. You have to learn that skill to be capable of deploying a controlled aggression. But to do that, you've got to be trialing and erroring it. Okay, it is very much a case of doing a trade 10 times, 20 times, 100 times, and eventually you know the right context, the right environment to put that 2 lot, to put that 3 lot, to put that 10 lot, that 100 lot on. Okay, that is the key to controlled aggression. And if done correctly, what you get ultimately is not just an exponential curve, but as you can see, you get a massively widening gap between the 1 lot trader and ultimately the controlled aggression trader. Okay. At the end of year 4, the reality is Mr. Controlled Aggression has got a $100,000 account. Okay, we can all accept that, wow, okay, yeah, I could do this job for 90 grand over 4 years. Sure, it's not a great wage, but at a 100K account, what that means is it opens the door to me making a 7-figure year. Okay, and if I can make a 7-figure year, nothing stops me from making an 8-figure year. And that's ultimately the key to this. If you can deploy controlled aggression, the skill itself will enable you to make 7-figure years. And that's what you need to be striving towards. Get away from the mentality of playing this game safe. If that's your mentality, if that's how you're going to approach it, holistically and realistically, your curve is going to be flat. To the point that, unfortunately, Mr. Controlled Aggression is the one that is going to ultimately get to 7 figures. And you, Mr. One Lot Trader, are unfortunately going to eventually have to bow out and go get a paid job. That's unfortunately the reality of this job. Okay, that's what opportunistic trading is all about. Learn to deploy controlled aggression.